There's a sentence being said at kitchen tables all over this country right now. We're just going to wait until rates come down. It sounds patient. It sounds responsible. And for a lot of people saying it, it's quietly the most expensive decision they'll make this decade. Because the thing they're waiting for is the exact thing that will price them out. I'm Ben, and today I'm going to explain why waiting for mortgage rates to drop can cost you more than buying at a higher rate. Let's start with the number everyone's watching. The average 30-year mortgage rate is sitting at 6.67%. It's been hovering just under 7% all year. It has not cooperated with anybody's plan, and every month it doesn't budge. Another wave of buyers decides to sit this one out and check back later. Now, here's the part that almost nobody thinks through. What actually happens on the day rates finally drop? Picture a room. There are 100 people standing around the edges, arms folded, watching the door. They all want a house. They're all waiting for the same signal. And there are only so many chairs in the middle of the room. When that signal finally comes, nobody walks. Everybody runs for the same chairs at the same second. That's not a metaphor I made up to sound clever. The chief economist at the National Association of Realtors said out loud that the housing market would be thriving if rates got back near 6%. Read that again from a buyer's chair. Thriving means bidding wars. It means waived inspections. It means the house you wanted going for over asking to somebody who moved faster than you did. So the low rate arrives, and it arrives holding hands with a higher price and more competition. You wanted one and got all three. Which brings me to Kayla and Derek. They're renting a 2-bedroom outside Charlotte, both working, and they've been saving hard for a down payment since 2024. Solid people doing everything right. Every few months they look at the market, see rates in the high sixes, and decide to give it another 6 months. They've done that 4 times now. Here's what happened while they were being patient. The median price of an existing home in this country is now $434,100. That price has gone up compared to the year before for 37 straight months. 37? Not a spike, not a bubble popping, just a slow, boring, relentless climb through every single month. Kayla and Derek were waiting for a better moment. Their down payment savings grew. The price of the thing they were saving for grew too. They've been running up an escalator that's moving down, and the rent they paid the whole time gone. Every dollar of it. It bought them a place to sleep, which is not nothing, but it built them exactly zero ownership in anything. Now, let me explain why the supply side is stuck, because this is the part that makes the whole thing click. Think about Ron. He's in his 50s, bought his house in 2021, locked in a rate around 3%. His kids are gone. The house is too big. He genuinely likes something smaller. But if Ron sells and buys a smaller house, he trades a 3% mortgage for one near 7%. He could downsize into less house and end up with a bigger payment. So Ron doesn't move. Neither do millions of people exactly like him. Think about what that does to the market. Every existing home that goes up for sale usually comes from somebody moving somewhere else. Upsizing, downsizing, relocating for a job. That's the engine that produces listings. Right now, that engine is running at a fraction of speed because a huge share of American homeowners are sitting on rates they will never see again in their lifetime, and they know it. That's why the number of homes for sale actually shrank compared to a year ago, not grew. Shrank. Everyone assumes the waiting game means more inventory piling up, and the opposite is happening.
Sellers are locked in their houses by their own low rates, and they're only coming out when their rate stops being a golden handcuff, which is to say, when rates come down. Same event, same day, same rush. Here's a twist that should genuinely change how you are thinking about this. Even with record prices, homes are more affordable today than they were a year ago. That's not a typo. The affordability measure the realtors track improved in every region of the country because incomes rose while rates drifted slightly lower than last summer's level. The improvement Kayla and Derek have been waiting for has partly already shown up. They just didn't recognize it because they were watching the rate instead of watching what they could actually afford. Now, let me be straight with you because I don't want anyone buying a house because of a video. Waiting is genuinely the right call for a lot of people. If your income isn't stable, wait. If you have no emergency fund left over after the down payment, wait. If there's a real chance you'll move in the next 3 years, buying is probably a losing trade no matter what the rate is because closing costs and selling fees will eat you alive on a short hold. And in some markets, especially parts of the South and West where builders have been busy, there's more supply and prices are genuinely softening. This is not one national housing market, it's thousands of local ones. The point isn't that everyone should buy right now. The point is that waiting for rates is not a strategy. It's a hope with no exit condition. So here's what to actually do. First, stop comparing the rate to some remembered number from 2021 and start comparing your rent to a real total payment. Pick one actual listing you'd actually live in. Add up principal, interest, property taxes, insurance, and set aside something for maintenance because the furnace is your problem now. Put that number next to your rent. Sometimes it's shockingly close. Sometimes it's not, and now you know instead of guessing. Second, shop at least 3 lenders, not one. People spend more time comparing hotel rooms than mortgages. Rates on the exact same borrower vary between lenders, and the difference over 30 years is not small. Third, ask about a seller-paid rate buy-down. Right now, sellers are competing for the small number of buyers who can actually transact, and many will pay to lower your rate for the first couple of years rather than cut the sticker price. Your agent should be raising this. If they're not, raise it yourself. And fourth, if you decide to wait, wait on purpose. Write down what has to be true before you buy. The down payment number, the stable job, the 5-year plan. That's a decision. Watching a rate chart and hoping is not. The bottom line is this. The rate is the one thing everybody watches and the one thing you control least. The price, the competition, and how prepared you are when the door opens, those move too. And they don't wait for you. If this helped, hit like, subscribe, and share it with someone who needs to hear it. I upload videos every day, so stay tuned.